Inflation is often explained in the simplest possible terms. Prices go up. Your money buys less. The cost of living rises. But inflation is not merely an economic inconvenience. It is not just about groceries, gasoline, or rent. Inflation is a structural force. It is a policy instrument. It is a transfer mechanism. And in highly indebted financial systems, it becomes something even more powerful, a pressure release valve. To understand inflation, we must first separate perception from mechanism. Most people experience inflation as a consumer event. A higher receipt at the supermarket, a rent increase, a jump in insurance premiums, a mortgage payment that feels heavier than it did just a few years ago. But those price changes are symptoms. The real story begins much earlier, at the level of money creation. Modern money is not backed by gold or silver. It is backed by trust and policy. It exists largely as digital entries on bank balance sheets. When banks lend, new money is created. When central banks purchase bonds or inject liquidity, money supply expands further. Money enters the system through credit, and credit is deeply connected to debt. In a low-debt world, inflation can be disruptive. But in a high-debt world, inflation can be useful. Consider a government that owes vast sums of money. If economic growth slows and tax revenue stagnates, servicing that debt becomes more difficult. Raising taxes is politically dangerous. Cutting spending risks recession. Default would trigger systemic shock. Inflation, however, operates quietly. If the value of money declines gradually, the real burden of outstanding debt shrinks in proportion. $1 trillion owed today becomes less costly in real terms tomorrow. No official announcement is required. The debt is not erased, it is diluted. This is the inflation illusion, because from the outside, nothing appears dramatic. The currency still functions. Salaries adjust slowly. Markets continue operating. But purchasing power declines year after year, and over decades, that decline compounds. 2% annual inflation may appear harmless, but over 30 years, it erodes nearly half of purchasing power. At 4%, erosion accelerates dramatically. At higher rates, the effect becomes unmistakable. Inflation is not a sudden explosion. It is gradual corrosion. But inflation does not affect everyone equally. Money enters the system unevenly. When central banks expand liquidity, it does not land simultaneously in every household. It moves through financial channels, government spending programs, bond purchases, bank reserves, asset markets. Those closest to the source, financial institutions, corporations, asset holders, receive the new money first. They transact at old prices before the broader economy adjusts. By the time inflation reaches wages and consumer goods, asset prices may have already surged. This phenomenon has long been understood in monetary economics. The first recipients benefit. The last recipients absorb the cost. That dynamic shapes wealth distribution. Asset inflation often precedes consumer inflation. Stocks rise, real estate appreciates, commodities rally, balance sheets expand in nominal terms. Meanwhile, wages lag. Savings held in cash lose real value. Fixed income earners experience gradual erosion. This is why inflation can widen inequality without dramatic headlines. It is not simply that prices rise. It is that purchasing power redistributes. Inflation also distorts signals. In healthy markets, prices reflect supply and demand. Scarcity increases value. Productivity improves purchasing power. Risk is priced into capital allocation. But when money supply expands rapidly, price increases may reflect liquidity rather than productivity. Asset bubbles can form under the surface of expansionary monetary conditions. Investors seek returns in an environment where cash yields little. Risk-taking increases. Leverage grows. Capital chases yield. Inflation becomes embedded not only in consumer goods, but in valuations. Then comes the second layer of illusion. Inflation statistics. Governments measure inflation using consumer price indices, baskets of goods and services designed to represent typical consumption. These indices evolve over time. Substitutions are made, weightings are adjusted, methodologies are updated. These changes are often technical and justifiable. But inflation measurement is not identical to lived experience. Housing costs, healthcare, education, insurance, these categories often rise faster than headline inflation suggests. At the same time, technological goods may fall in price, offsetting upward pressures in official metrics. The result is a perception gap. Official inflation may appear moderate, while personal financial pressure feels intense. That gap influences trust. Because inflation is not purely mathematical, it is psychological. If households believe prices will continue rising, behavior changes. Spending accelerates. Wage demands increase. Businesses preemptively raise prices. Expectations reinforce outcomes. Central banks understand this dynamic deeply. Modern monetary policy focuses heavily on expectations management. Forward guidance. Policy signaling. Interest rate adjustments. Communication strategies. The goal is not only to manage money supply, but to manage perception. If people believe inflation will remain anchored at target levels, behavior stabilizes. If expectations drift, control weakens. This is where inflation becomes dangerous. Because controlling inflation in a high-debt world is extraordinarily difficult. Raising interest rates cools inflation by tightening credit. Borrowing slows, spending declines. Demand softens. But higher rates also increase the cost of servicing debt. Governments must allocate more revenue toward interest payments. Corporations refinance at higher costs. Households struggle with variable rate loans. Financial markets reprice risk rapidly. If rates rise too quickly, recession becomes likely. If rates remain too low, inflation persists. Central banks operate in this narrow corridor, trying to balance stability and erosion. History shows how fragile this balance can be. In the 1970s, inflation surged across advanced economies. Oil shocks, monetary expansion, and shifting expectations drove prices upward. Central banks initially hesitated to tighten aggressively. Inflation became entrenched. Eventually, severe rate hikes were required. The resulting recessions were painful but necessary to restore credibility. Today's environment is more complex. Globalization once suppressed inflation by integrating low-cost labor markets and efficient supply chains. Technology increased productivity and transparency. Demographic shifts influenced consumption patterns. But global shocks, pandemics, geopolitical tensions, supply chain disruptions have reintroduced volatility into pricing. At the same time, global debt levels are significantly higher than in previous inflationary episodes. This limits policy flexibility. The higher the debt, the more sensitive the system becomes to rate increases. This creates an uncomfortable possibility. If inflation becomes persistent, tightening policy aggressively could destabilize the financial system. If tightening is restrained to protect stability, inflation may remain elevated. The longer inflation persists, the more it reshapes behavior. Long-term contracts adjust. Wage negotiations incorporate higher expectations. Investment decisions shift toward inflation hedges. Confidence in currency subtly erodes. And once confidence weakens significantly, stabilization becomes exponentially more difficult. Currencies ultimately rest on trust. Trust that purchasing power will be preserved. Trust that obligations will be honored. Trust that policymakers can maintain stability. When that trust is strong, moderate inflation is tolerated. When trust weakens, capital seeks alternatives. Hard assets, foreign currencies, digital assets, commodity exposure. Capital flight can begin quietly, long before headlines acknowledge instability. Inflation also influences geopolitics. If one nation experiences persistent inflation while another maintains stability, exchange rates adjust. Trade competitiveness shifts. Capital reallocates globally. Reserve currencies hold privileged positions because of stability and trust. Persistent inflation can challenge that position. This adds another layer to the inflation illusion. Inflation is domestic and global simultaneously. It affects households and international capital flows. It reshapes politics and portfolio allocations. It alters power balances between nations. But perhaps the most subtle aspect of inflation is normalization. Humans adapt. Prices double over decades and seem ordinary. What once felt expensive becomes standard. Nominal incomes rise and obscure real erosion. Inflation rarely feels like theft. It feels like inconvenience. But compounded over generations, it changes the economic landscape profoundly. Retirement planning becomes more complex. Savings strategies must incorporate asset exposure. Debt becomes structurally embedded in the economy. Growth models depend on credit expansion. Inflation becomes a permanent feature rather than a temporary deviation. The illusion is that inflation is accidental, temporary, or purely external. The deeper reality is that inflation often reflects structural design. It may be a requirement. The challenge is maintaining it at levels that relieve pressure without undermining trust. That balance is delicate, because once trust erodes, restoring it demands painful correction. Inflation is not merely rising prices. It is the quiet transformation of purchasing power. It is the mechanism through which debt is diluted. It is the channel through which wealth shifts. It is the test of policy credibility. Inflation is not an isolated phenomenon. It is the connective tissue, the silent force shaping outcomes behind the scenes. Understanding inflation means understanding the architecture of the system itself. And in that understanding lies clarity. Because inflation is only an illusion if you see it only at the surface. Beneath it lies design, and design always reveals intent. Welcome to Cash and Chronicles, where money, power, and history collide.